In 1637 Amsterdam, a single unplanted flower bulb traded for the price of this luxury estate. At the time, the Netherlands was the richest country on earth. The Dutch Golden Age was in full swing, and merchants trading global spices were pulling in staggering, unprecedented amounts of cash. Suddenly, thousands of people had vast reserves of disposable income. They wanted to show off, and they desperately needed a highly visible way to prove they had arrived in high society. Enter the tulip. Brought over from the Ottoman Empire, its vivid colors and elegant shape were entirely foreign to Europe, making it the perfect status symbol for a merchant looking to stand out. With the spice trade providing more wealth than there were luxury goods to buy, the exotic tulip arrived exactly when the Dutch elite were looking for something new to value. The trigger for the mania ended up being a biological anomaly. A random virus infected the plants, causing the solid petals to break into stunning, unpredictable stripes, the most famous being the Semper Augustus. Take a look at this chart. Because farmers couldn't control the virus, the supply of these striped tulips stayed flat, even as their popularity exploded, sending the demand line straight upward. This created an extreme, rigid scarcity. Long before limited edition sneakers or rare trading cards existed, the striped tulip became a must-have. As everyday citizens watched their wealthy neighbors triple their net worth trading these rare flowers, a massive wave of fear of missing out swept through the country. Everyone wanted in. This uncontrollable biological rarity meant that even the wealthiest buyers had to fiercely compete for a finite number of bulbs, shifting the tulip from a simple garden flower to a high-stakes competitive asset. But trading physical flowers hits a hard logistical wall. A tulip only blooms for about a week in the spring, and you can only safely uproot and move the bulb for a few months in the late summer. So how do impatient merchants keep a financial frenzy going while the product is buried under a foot of winter snow? This timeline lays out the physical reality. To bridge the gap between a winter freeze and a summer harvest, traders invented the futures contract. Instead of waiting, buyers signed agreements, locking in set prices, trading pieces of paper for bulbs still in the ground. By allowing traders to buy and sell flowers that weren't even in the ground yet, this system removed the physical constraints of the growing season and enabled constant, year-round speculation. Traders completely stopped dealing in physical flowers. They were buying and selling paper promises, basing their decisions on projections of what a bulb might be worth months down the line. It looks incredibly similar to the roaring 1920s stock market boom. When a local barber or shoeshine boy starts handing out financial tips because everyone assumes prices will rise forever, the market has left reality behind. The underlying math completely broke down. Prices detached entirely from the actual value of a plant that would eventually wither and die. It closely mirrors the accounting tricks used by Enron, where traders were booking massive profits on deals that hadn't actually occurred yet, relying on figures that only existed on paper. At the peak of the mania, people were trading away their life savings, land, and entire herds of livestock for contracts on flowers they had never laid eyes on. Once the market is trading the idea of a bulb rather than the bulb itself, the price is limited only by how much the next person is willing to pay, a cycle that depends entirely on a constant stream of new buyers. The illusion shattered in February 1637. During a routine tulip auction in the town of Haarlem, a seller put a batch of bulbs up for sale at a very high asking price. Nobody bid. He lowered the price. Still, silence. The buyers looked around the room and simultaneously realized they were offering a lifetime's wages for decorative garlic. Look at this pricing graph. The moment that realization hit, the market didn't slide. It crashed to near zero. Panic spread like wildfire as everyone rushed to sell, and absolutely no one was willing to buy. Financial bubbles do not just slowly deflate. Once the collective belief in the value of an asset vanishes, it can disappear entirely in a single afternoon. The government had to step in, decreeing that all those expensive futures contracts could be settled for a tiny fraction of their original price. Overnight, wealthy tulip barons went back to being bakers and blacksmiths. This feeling of holding worthless assets hit modern banks during the 2008 financial crisis, when traders realized their complex subprime mortgage portfolios were actually just bundles of bad debt. Whether it is a 17th century flower, a 1990s tech startup, or modern cryptocurrency, the psychological cycle repeats with striking consistency. Whenever a society collectively agrees that an asset will go up forever, they stack debt and while the same. Keep a close eye on your investments, and maybe don't mortgage your life for a houseplant.